Hi, welcome to Binance Academy's Trading and Investing Strategies course. Now, you've hopefully got a grasp of the basic concepts of trading and investing. Let's dive deeper into the different ways you can trade. We'll begin this course with the first module on portfolio and risk management. So, what is portfolio management? Your portfolio is a collection of assets and investments. Just like you can strategically manage your individual investments, you can also strategically manage your portfolio as a whole. A portfolio can contain real estate, stocks, cryptocurrencies, and even trading cards. Anything you invest in can be part of your portfolio. If you're only trading cryptocurrencies, it will likely be made up of a combination of Bitcoin and other altcoins. Each part of your portfolio can work together and contribute to an overall strategy. The first step to good portfolio management is setting your expectations. Are you risk-averse and looking for a basket of investments protected from high volatility? Or do you want something riskier with potentially higher returns in the short term? There are endless possibilities of how to put together your portfolio. It can be as complex or simple as you want, but it's recommended that you do some research and put in some thought. The amount of time you want to stay invested also matters. You could take a passive hands-off strategy and leave your investments alone after you set them up. On the other hand, you can take an active approach, continuously buying and selling assets to profit. The key to determining your portfolio strategy lies in how you want to manage your risk. There are many kinds of risks you might encounter while investing and trading. The first is market risk, the potential loss you experience if the asset loses value. The second is liquidity risk. This occurs in illiquid markets, where you cannot easily find buyers for your assets. This can also cause potential losses if you cannot sell at the price you want. Next is operational risk, where potential losses stem from operational failures such as human error, hardware or software failure, or intentional fraudulent conduct. Finally, we have systemic risk, including possible losses caused by the collapse of an entire industry, market, or financial system. One example would be Lehman Brothers' bankruptcy in 2007 and its effect on the global financial industry. Each asset you have in your portfolio will have some risk associated with it. For example, a new cryptocurrency without a large market for buyers will have more liquidity risk. But the risk won't always be internal and manageable with your portfolio. Sometimes external factors like our Lehman Brothers example or a global recession can't be avoided. So how do you begin to assess these risks, the likelihood of encountering them, and their severity? An excellent place to start is by ranking your investments from high risk to low risk. From there, you can check each asset's price volatility, liquidity, industry health, and other related news. After identifying your higher risk investments and the kinds of risks they have, the next step is to decide how much you want to offset that risk. For example, if you have many crypto investments, you may want to balance this out and diversify with government bonds or other low-risk investments. You can also allocate your assets strategically within an asset class, such as stocks or crypto. For example, you could get stocks in utilities or technology companies if you have a high systemic risk from holding stocks all within the financial industry. Great! You should know by now the most essential concepts within portfolio and risk management.